What if I told you that the entire global economy operates according to the same internal logic as a scam? That every dollar you try to save, every pension contribution you make for security, every mortgage payment you send month after month is not just a personal financial act, but a necessary payment into a structure that only remains standing if a constant stream of new participants keeps entering underneath you and pushing money upward to those above? What if the basic way our financial world works is not an unfortunate side effect, but deliberate design? This isn't about some shady fraud happening in the margins of finance. It's not just one illegal operation run out of a boiler room. This, in practical terms, is the operating system of the modern world. And here's the part that people do not like to face directly. The only reason it hasn't already imploded is because governments, commercial banks, and central banks continuously manufacture more entrants, more credit, and more stories to keep belief alive. The structure can't sit still. It has to keep expanding or it starts dying. That means the important question is not, will it fail? Because a system built on endless expansion in a world with limits is guaranteed to hit a wall. The real question is, when the break happens, who absorbs the damage, and who gets ground into dust so that everyone else can walk away? To see why that is, you have to understand what a pyramid scheme actually is, without the comforting language and without the polite labels. A pyramid scheme is not complicated. It offers spectacular returns, the kind of payoff that sounds almost absurd, and it claims those gains are safe and repeatable. But under the surface, it doesn't generate new value. It doesn't build anything that earns real income. Instead, it pays early participants using the money brought in by later participants. That's the entire engine. Charles Ponzi made this infamous in 1920 when he told investors he could deliver a 50% return in just 90 days. At first, it looked like he was some kind of financial genius. When people asked for their money back, he actually paid them right on time. That performance created the illusion of reliability. And that illusion is what drew even more people in. Money was pouring toward him because everyone believed the first wave of payouts proved that it worked. But the math behind it was brutal. Each new layer had to be bigger than the previous layer. Each round had to attract more people, more money, more blind confidence, just to keep the earlier promises from collapsing. Within months, the machine was too big to feed. It fell apart, and thousands of people were wiped out. Ponzi went to prison. His name became the label for this model forever. But the important part is why it failed. A pyramid scheme is unsustainable because it demands infinite growth in a world that is finite. At some point, you run out of fresh believers, and when the flow of new money stops, the whole thing snaps. Now comes the part that should feel unsettling. If you remove the legal technicalities and just examine how money moves, the global economy runs on that same logic. Look around at the core layers. Governments borrow trillions, not out of wealth they already produced, but out of obligations pushed forward onto people who haven't even been born yet. Corporations raise debt and then use that borrowed money not mainly to innovate or improve productivity, but to buy back their own stock, which inflates share prices and rewards existing shareholders and executives, while pushing the actual cost of that leverage into the future. Regular households are trained to live permanently on credit cards, car loans, and multi-decade mortgages, paying interest for years while barely touching the principal. And what about the money itself? That's the part most people never get told plainly. It is not backed by gold or silver or any hard backing you can actually hold. It is created out of nothing every time a bank writes a loan. That cash in your pocket, that number in your account, that balance you think exists somewhere in a vault. That was not printed in the way most people imagine. It was lent into existence. Under something called fractional reserve banking, when you deposit $1,000, the bank is only required to keep a small fraction of that, maybe 10% in reserve. The rest can be issued out again as new loans. That loan then becomes new money in the system. The person who received that loan can deposit it at another bank, and that bank will also keep just a fraction and lend out the remainder, which once again becomes money. From your initial $1,000, the system can spin out multiple thousands of dollars in new credit just by repeating this step. On paper, everyone looks richer, balances rise, asset prices rise. The appearance is prosperity. In reality, what you have is layer stacked on layer, stacked on layer. A tower of claims, not a tower of assets. It functions exactly like a pyramid. The structure only stands as long as people are confident, and nobody demands all of it back at once. The moment that confidence breaks, deposits get pulled, banks face runs, and the whole thing starts seizing up. When that happens at scale, you get collapses and emergency rescues, exactly like what the world saw during the Great Depression and then again in 2008, when the modern housing and credit bubbles snapped. This machine did not appear overnight. It has a timeline. After the Second World War, the world rebuilt under what was known as the Bretton Woods Arrangement. Under that system, global finance was anchored to the US dollar, and the US dollar itself was tied to gold. That link to something physical created at least the perception of restraint. But that structure ended in 1971 when Richard Nixon closed what was called the gold window. From that point on, the anchor was cut. The global financial order was no longer backed by metal in a vault. It was now based entirely on fiat currency, money declared to have value by governments, and accepted because people believe in those governments. Fiat money rests on faith, and faith can evaporate. So, to keep faith alive, governments had to start promising one thing over and over: endless growth. And they had to show that growth quarter after quarter, year after year, even when reality didn't justify it. That growth was increasingly fueled by more debt, by more money creation, and by the output of your time and labor. In other words, the arrangement demands continuous expansion funded by borrowing, inflation, and work extracted from you. When you hear promises about stability and prosperity, what you are actually being told is that the system must constantly feed itself to survive. That should sound familiar. Structurally, that is what a pyramid looks like. Take pensions and social security systems. People are told that what they pay in during their working years is being stored for them, waiting quietly until retirement. But in reality, those payouts do not come from some isolated vault where your money sits growing. They are funded by the contributions of younger, currently working people who are paying right now. That setup is manageable if the base of contributors is always expanding and always large enough to support the layer above it. But in countries where the population is aging, places like Japan, Italy, and even the United States, that base is shrinking. There are fewer young workers paying in, but there are more retirees who have been promised benefits. The obligation owed to the top keeps swelling while the inflow from the bottom thins out. That is not sustainable math. It is a demographic version of a pyramid scheme, and the arithmetic fails as soon as the shape of the population stops widening at the bottom. Governments respond the same way every time. They borrow more money and they create more money. They apply patches instead of solving the core imbalance. But every new patch just digs the hole deeper and moves the shortfall forward instead of eliminating it. Look at housing. For years, home prices in many parts of the developed world have not been justified by what the homes are actually worth in terms of utility or income generation. Instead, they have been justified by what the next buyer will be forced to hand over using borrowed money. Each surge in prices relies on a fresh wave of new buyers coming in underneath and agreeing to take on larger and larger debts just to enter the market at all. Every boom feeds on new entrants at the bottom of the ladder who keep stretching themselves thinner. But when affordability finally collapses, which is happening now in many places, the base of the pyramid shrinks. Fewer people can qualify. Fewer households can afford to jump in and hold the next layer of debt. When that happens, the illusion that housing always goes up cracks, and what people believed was guaranteed wealth can evaporate almost instantly. Paper equity disappears. Lifetimes of payments can be exposed as leverage, not security. The exact same logic shows up in financial markets. Stock prices do not move only because of a company's earnings or some measured assessment of long-term value. They are also driven by the idea that someone else will show up later and buy those same shares at a higher price. It is the greater fool expectation built into the structure. The same psychology is even more naked in crypto. Crypto makes that mindset obvious. The earliest holders become extremely wealthy only if a flood of later buyers agrees to believe in the token, buy the token, and keep pushing the price higher. But it would be a mistake to pretend that this pattern is limited to crypto. That mindset, the idea that gains depend on a new wave of participants coming in after you, is present across the financial system as a whole. It is not the exception. It is the rule. And when the structure starts cracking, When reality finally pushes back and the lower layers can't keep feeding the upper ones, that is when the real architect of the modern pyramid steps in, the central bank. In 2008, when the housing pyramid and the credit structure that sat on top of it finally buckled, the Federal Reserve and other central banks around the world responded by creating trillions of dollars. The polite name for this was quantitative easing, but functionally it meant pumping brand new money into the system to keep it alive. Old debts were paid and rolled over with newly created money. Bad bets were absorbed and covered. Losses that should have taken down major players were instead distributed across the public through national balance sheets. Meanwhile, the profits and gains made during the bubble stayed in private hands. The pyramid did not get dismantled. It was rebuilt, only larger and even more dependent on artificial support, and the cost of rescuing it did not disappear. That cost was shifted onto you, the saver watching purchasing power erode, the worker dealing with stagnating real wages, the taxpayer funding bailouts and stability measures, the ordinary person who ended up paying through higher living costs and through austerity. Your standard of living quietly absorbed the blow so that the structure at the top could continue operating. History shows this pattern in clear form, again and again. The South Sea Bubble of 1720 convinced investors that massive profits would flow from trade with South America. People poured their money into those promises and were annihilated financially when the scheme collapsed. The Great Depression of the 1930s arrived after a frenzy of speculation and leverage that then imploded, wiping out savings and destroying livelihoods on a massive scale. The Japanese asset bubble of the 1980s pushed real estate and stock prices to levels that made no sense. Land in Tokyo being spoken about as if it were worth more than all the real estate in California combined, until it all finally crashed and Japan fell into what became known as the Lost Decade. These are not random, isolated bursts of madness. They are case studies of the same recurring structure, an expanding tower built on belief and on constantly rising valuations that demand a steady stream of new money to sustain them. Every one of these episodes shares the same DNA. They are systems that required endless injections of fresh money and endless waves of new believers to keep pretending that the numbers made sense, right up until reality intruded and the math could no longer be stretched. Over time, we have normalized this pattern and given it respectable language. We do not call it a pyramid when it's happening in respectable boardrooms or in national policy. We call it growth. We call it stimulus. We call it the economy. But if the machine cannot survive without nonstop infusions of new debt and a steady supply of new participants who will carry that debt, then maybe what we are looking at is not a foundation at all. Maybe it is a structure built on sand, constantly shifting, constantly at risk. And maybe you and I are the ones standing at the bottom, physically holding it up with our wages, our savings, and our time. Right now, the pyramid is taller and heavier than it has ever been. Global debt is estimated at more than $300 trillion. Put differently, the total IOU of governments, corporations, and households combined is roughly 3 times bigger than the entire world's yearly economic output. The planet, in total, owes about 3 full years of its collective labor just to get back to zero. And yet, if you listen to the way politicians, mainstream economists, and central bankers talk, the answer is always presented as more of the same. The proposed fix is more debt, more so-called growth funded by that new debt, more borrowing from the future to cover the holes of the present. It is the logic of a Ponzi structure that everybody quietly acknowledges, but almost no one dares to actually stop. Because the instant the inflow of new money slows, the framework risks falling in on itself. The people in charge know that if they stop feeding it, collapse becomes immediate. So they do not stop. They keep feeding it. This is also why inflation hits ordinary people so hard. Inflation is the quiet mechanism by which the pyramid takes its payment. Prices don't just rise because supply and demand shift. Prices also rise because new money floods into the system every time a government runs a deficit and spends beyond its income, or every time a central bank steps in to prop up markets and absorb losses that would otherwise cascade. When the creation of money races ahead of the creation of real value, the result is simple. The money you earn buys less. Your wages stretch less. Your savings lose purchasing power. Your pension promises shrink in real terms. Inflation is not a random accident. It is not a glitch. It is the embedded cost of keeping this structure alive for another cycle. It is the system's way of saying, we will keep things standing for one more round, but the price will be taken from you, the normal participant at the base. The demographic problem makes that pressure even worse. Social Security and pension systems in the West assume that a large, younger working population will keep funding the retirement of older generations. But birth rates have been dropping, and life expectancy has been rising, which means people are living longer after they stop working and are drawing benefits for more years, while there are fewer young workers available to carry them. The base of the pyramid is thinning out exactly where it needs to widen. In Japan, sales of adult diapers have already surpassed sales of baby diapers. That single fact is more than a social detail. It is an economic warning signal. You can see the same trend moving through Europe and, increasingly, through the United States. The structure of these retirement promises is essentially a pyramid. Money flows upward to retirees from the active workers below. That works only as long as there are enough new contributors constantly entering at the bottom. Without that constant growth, the promise fails. The numbers do not balance. The obligation can't be met without either cutting benefits, borrowing even more, or creating even more money out of nothing. And the addiction to rescue doesn't fade. It keeps getting stronger. Every major crash of the last century has produced the same style of response. The Great Depression led to the New Deal and a massive broadening of government-backed financial support, along with an expansion of fiat-style money management. The oil shocks in the 1970s brought what was called petrodollar recycling, where oil profits were channeled back into U.S. Treasury bonds to keep the global machine liquid and running. The housing and credit crash of 2008 triggered trillions in quantitative easing, where central banks pushed newly created money directly into the financial system. The 2020 pandemic response repeated the same playbook, only on a scale never witnessed before. In every one of those cases, the chosen answer was not to reset the structure or admit that the model itself might be flawed. The answer was to double down. The answer was to extend the pyramid, to reinforce it with even more borrowed money and even more created money, and to shove the real reckoning further into the future so that someone else would be forced to deal with it later. Meanwhile, the winners remain consistent. Just like in any pyramid-style setup, the people near the top, the ones who get in early, the ones who control the levers, are positioned to extract the most benefit. Banks collect interest on loans that were effectively conjured into existence. Corporations issue debt and then use that debt to buy their own shares, pushing stock prices higher and funneling rewards to executives and existing shareholders. Politicians promise benefits and protections today that they understand will have to be paid for by someone else tomorrow. And then there is you. You are the saver whose purchasing power gets diluted. You are the worker whose wages are pressured. You are the latecomer who is still feeding the machine while being told that this is stability. In the end, you are the one left holding the bag when the bill comes due. This is why the pyramid comparison matters. Once you recognize the structure, it becomes impossible to unsee it. The global economy has not collapsed outright because governments possess tools that Charles Ponzi never did. They can create money by decree. They can enforce taxation to guarantee inflows. They can even project military power and secure resources to protect the system's survival. Those tools make the structure look stronger and more permanent than a backyard scam. But the underlying architecture is the same. It still depends on an endless supply of new money, on an endless supply of believers, and on an endless outward expansion. And there is a limit. No pyramid, no matter how sophisticated or how officially managed, can expand forever. At some point, growth slows, and when growth slows, strain shows up at the bottom first. So, what is the lesson you are supposed to take from this? First, stop assuming that the system was designed for your benefit. It was not. The financial order is designed first and foremost to keep itself intact. Inflation is not treated as a disaster by the system. It is treated as a release valve. Debt is not treated as a red flag. It is treated as fuel. Bailouts are not treated as a last resort. They are treated as standard procedure. These are not accidents. These are features. Second, understand that real security is not located in the promises issued by that same system. Real security lives in what can survive outside its abstractions. The skills you can personally apply, the relationships and networks that can function without constant borrowing, the tangible resources you can actually access, and diversified holdings that do not disappear the moment belief in the official structure weakens. And finally, recognize that financial freedom does not arrive because a government steps in and rescues you. It arrives when you understand how the machine operates and learn to avoid its most obvious traps. The modern global economy may not technically be labeled a pyramid scheme in a legal sense, but in terms of structure, it strongly rhymes with one. It keeps functioning only as long as the base keeps feeding it, and history has shown, over and over, that when the base weakens, when the stream of new money runs thin, when confidence finally breaks, the fall that follows is severe. History does not repeat, but it does rhyme. If you confuse a pyramid with a foundation, if you build your future on something that only stands as long as fresh layers keep forming underneath you, it will eventually give way. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.